What if you could learn the secrets to a trading strategy with an 80% win rate, proven across hundreds of real setups, in under 10 minutes? In today's episode, we're building a working trading system from scratch. This is the exact system I've used to scale accounts from $10,000 to $100,000, quarter after quarter. In the next few minutes, you'll discover how to choose high-conviction trade zones, manage risk like a professional, build consistency into your trading system, scale in and out of trades with confidence, use structure and sentiment to sharpen your entries. This system is designed for swing and scalp traders who want consistent results without spending hours watching the 15-minute chart. Instead, we rely on the more reliable daily and 4-hour timeframes to cut through the noise and trade smarter. Let's start with the core of any great trading system: risk management. This isn't just about avoiding losses, it's your primary edge. Most traders lose not because their strategy fails, but because they risk too much, too early. They average down on losing positions or bail on winning ones. With our approach, we define risk up front and let the math work in our favor. That's how we grow accounts without emotional swings. Here's a simple way to understand how edge works in trading. Imagine this. I give you $2 for every heads, and you give me $1 for every tails. Would you take the bet? Let's say we flip the coin 10 times. You get 3 heads, that's $6 in gains. But 7 tails cost you $7. You're down $1. Not great, yet. But over 100 flips, the odds shift, and your edge shows. That's trading. You don't need to win every time. The key is to stay in the game, lose small, and win big. With our system, backed by hundreds of real setups, we achieve a consistent 80% win rate in trending crypto markets. Now let's apply that to a real account. Suppose you start with $10,000. The first goal? Survival. In the early stages, we risk only 1% per trade. That means risking $100 to potentially make $500 based on a 1 to 5 risk to reward setup. It's all about staying in the game and letting high probability trades carry us forward. Once your account grows, say to $12,000, now you're playing with house money. At this point, we can slightly increase our position size, but only on the very best setups. This lets us scale using profits, not principal. And that's how you build equity without gambling. Next, let's talk about how the big players think. When you see equal highs or equal lows forming on a chart, that's a sign of liquidity, often a trap for retail traders. Market makers target these zones to fill their positions by triggering stop losses and automatic selling. We wait for that liquidity sweep. Once price reclaims the range and starts shifting structure, higher lows, strong closes, we know the smart money has finished accumulating. That's our signal to enter with conviction. Position sizing is where many traders go wrong. Use tools like beatertrotter.com to calculate your exact trade size. For example, you have $10,000 in capital and risk 1% on a trade. Your stop loss is 5% away. With 10x leverage, you can open a $2,000 position by risking just $100. Even after 10 losing trades, you'd still have $9,000. But if you lose 50%, you'd need to double that to recover. Prioritize risk management. It's the most powerful compounding strategy in trading. Every trade should include an exit strategy. We use 3 profit zones. TP1, the sleep easy, exit 1/3 of the trade at 1 to 2 to cancel risk. TP2, the moneymaker, our main target, often around 1 to 4. TP3, the gambler, a small runner we let ride in strong trends. This strategy ensures most of our trades are either flat or profitable. We reduce risk early and let profits run when the market supports it. Before entering any trade, we zoom out. Weekly and daily charts show the big picture. They filter out noise and highlight true trends. The tools we use include Fibonacci retracements, 21, 50, and 200 EMAs, stochastic RSI, order blocks for key price zones. These tools keep our system objective and repeatable. Before pulling the trigger, we need 3 confirmations. A liquidity sweep, stop hunting move. A reclaim and retest of structure. Bullish confirmation, such as a break in lower highs or strong RSI divergence. Patience here pays off. Let the market show its hand first. Let's put it all together with a live example, a trade on Phantom FTM. We identified a support zone at 34 cents and resistance around 50 cents. Once price formed a strong base and reclaimed a key order block, it closed above resistance. That was our trigger. If price fell back below the 4-hour low or lost the 21 EMA, that's our invalidation point. We cut the trade and protect capital. TP1 at 1 to 2 locked in gains and made the trade risk-free. TP2 at 1.4 was our main payday. We left a small runner, the gambler, but only if the daily closed above resistance. Volume confirmed strength. Price formed a bullish engulfing candle. Now we're in a position to scale further or walk away with profit. With the gambler in play, we now look for continuation. We start small, no more than 30% of our original size. As the trend holds, you can scale volume at each SR flip, raising your average entry as long as you keep it under your rising invalidation level. The trade is risk-free and printing. You can keep it running as long as it has higher highs. EMA support, strong volume, and trend continuation. Done right, this grows a single setup into a multi-stage trade, all while keeping risk controlled. Here's your recap. Start small, protect your capital. Trade with confirmation, not guesswork. Use 3 profit zones to structure exits. Let the gambler ride trends without risking core capital. This is how you build a high probability system that works in any market. In the next episode, we'll show you how to combine trend lines, fib levels, and liquidity to find sniper entries. Subscribe now to master this system, trade with confidence, and grow like a pro.